first, I do research. My area is strategic management, of course, and I do research in 3 different areas in strategic management. So resources and capabilities, which is a major area in strategic management. How do firms differ in terms of the resources and capabilities they possess? And then how do they differ in managing and governing their resources? So I do research on executive teams, top management teams, and corporate governance. And today, and the intersection, and interaction of these 2 components that I'm going to talk about today on these 2 circles primarily. So I think we do have some people here who are doing corporate governance research that I wanted to mention. So when I say corporate governance, I'm primarily talking about board governance. So the board governance, of course, is a very active component of overall corporate governance, because boards are sort of like they oversee managerial actions and they make sure that the company is going in the right direction. And typically they have 2 functions, right? The monitoring function is that oversight function, but then equally important is the resource provision function, which is providing guidance, advice to the top management team and the CEO. So those are the 2 major functions. And there has been, I think traditionally there has been a lot of emphasis on the monitoring function. So if you look at the US literature, right, it's the independence of the board directors. Are they appointed by the CEO? How many insiders are there? How many outsiders? But increasingly, the literature is now increasingly more interested in the resource provision function, and that's the advice component of it. And I wanted to...
Should the CEO be a part of the board if you are talking about resource provision? Or
CEOs in the US are almost always. They are part of the board of directors, but their position can be different in the sense that in the US, CEOs are very powerful. So oftentimes, so the board is a unit, but there's also the chair of the board. And it could be like up to 75% historically, the CEOs are also the chair of the board. And I think this ratio is different in other countries. And the CEOs don't want to give up that particular position, but as you can see, if you're the chair of an a unit that is supposed to keep an eye on you, there's a little bit of a conflict there as well. So that's a good question. So the way I got interested in this area is I came across a particular study a couple years ago. And so they talked to CEOs around the globe, and when they've given them this statement, so we have insider or outsider directors on board. So outside directors must understand what drives success in business, right? So remember, they are both monitoring and providing this guidance and advice to the CEO. But the question is, do they really know what's going on in the business? What drives success in business? So a lot of them agreed, of course, yes, this is so important. But when you give them the statement that outside directors do understand what drives success in business, maybe half of them or less than half of them actually agreed with this statement, right? So this is kind of a question that I've started with, is this really reflecting the overall reality in this area, whether directors know. And actually one study we did soon after this one is we looked at directors' experience at different levels of specificity, their experience in multiple boards, industry, firm, and so on, and we did find that they all represent fundamentally different knowledge bases. So that was kind of the starting point, and what I'm going to talk about today is not just the board of directors, but we are going to look at, in this particular paper, we look at the interaction between the CEO and the board of directors. And in particular, we are looking at the potential positive and negative synergies between the CEOs and the corporate board's human and social capital. Of course, I'm going to explain what that is. But the reason we wanted to look at both is because one of the very important insights that comes out in the board literature is that even though we talk about this oversight and monitoring function, what research shows that for the boards to be effective, there has to be a very good collaborative relationship between the CEO and the board of directors. Trust-based relationship. So if the relationship is a very top-down approach or there's lack of trust either parties, then the CEO, either because the CEO is the chair of the board, tries to manipulate, hide information, manage the agenda of the board meetings, or apply some social influence tactics and flattery, that kind of thing. So there's ample evidence of that. So that's why we wanted to look at the interaction. And I have a couple of co-authors, Shamu and Kuntara, both at San Diego State University. It's also kind of like where a lot of the biotech stuff happens. So I've done a little bit of this introduction already, the constructive collaborative relationship between the two parties. And so we're looking at this interaction, and primarily some of the research questions that we've been interested in include, does the board's human social capital always supplement and strengthen that of the CEO? Is more of a specific capital always better as the CEO report accumulates it? So this paper started as a human capital paper, and we've added the social capital component afterwards. But there is an assumption in the human capital literature that more is always better, right? So you have knowledge base, the more the better. But is that really always the case, right? Are there any costs associated with accumulating certain forms of capital? So these are some of our preliminary questions. And I wanted to give some definitions. So when we say human capital, what do we mean? This goes back to some of the original old definitions of human capital. So we're referring to individuals' expertise, knowledge, which could be gained through education. It could be gained through training or on-the-job experience, of course. And studies do show that when you do make investments in any of these categories, typically the individual's performance increases, and we also get an effect on the firm level performance as well. In the management literature also, Connie Helfand, and colleagues have a number of studies that they do also show that when you look at managers, they do have this hierarchy of skills. Some of the generic skills, I don't know, it could be certain leadership skills applied to multiple settings. But other skills are more specific to the industry or even very specific to the firm that may have value in one context and not in another context. And then the social capital is individuals' ability to access resources, information networks, this could be an internal network, outside network. But what I wanted to mention here is that, as I said, the study did start as a human capital study, partly because we do look at a lot of the professional experiences of both the CEO and the directors. And then one of the reviewers pointed out that, well, if you look at the experience, when you're accumulating know-how, but you're also building relationships. So then we kind of added the social capital component to it. But the study wasn't designed as a network study, that you see where you look at all the board interlocks and so on. So here's another interesting component. So I think this is where, I forgot to mention, one of our co-authors is a finance person. So we have this, little cross-disciplinary type of research. So we are looking at companies which complete an initial public offer, okay? So that is the context of the paper, which has implications for the theory. And so this is, of course, companies do go public, and why do companies go public? So they're transitioning from being private firms to public, so they start trading on the stock market. Why do they do that? Well, multiple reasons. It helps them to have access to cheaper, cost of capital, diversify their equity base, and so they can keep going back to the financial markets. It also, it's a prestige. If you're a public company, it's sort of like it's a different kind of a status, and also that might altogether help them to recruit higher quality managers and perhaps employees as well. So there are all these good benefits of being a public company. But what we wanted to focus here is that the fact that there are some serious challenges as you're taking the company from private to public domain. And that has a lot to do with the financial and competitive scrutiny. So of course the company starts issuing a lot of statements annually, quarterly, in the US, but I think it's also in Turkey. You have to disclose a lot more information about yourself. And I think the other interesting aspect of it is this competitive scrutiny. It's not that your competitors don't know you, but once you decide to go public, that does send them a message saying that you're going to a different league. You know, so there's also going to be perhaps increased attention from the rival firms as well. But from a financial point of view, I should also say that there is still a lot of information asymmetry when the company is getting ready to go public, and uncertainty about this firm. I think especially in the R&D domain, like biotech companies, right? So is the company going to make it? Are they really going to be successful in the future? Where are they going to be 5 years from now? So this is kind of like still somewhat speculative, despite that there is some information about the company. So typically, the companies need to signal that they have the ability to cope with these new demands of the financial and the competitive market. So, and what we know from the literature is that typically board of directors can be a critical signaling mechanism. So what are you signaling? Well, you know, boards are, you know, they can be a great source of advice, network access, you know, overall credibility. So I may not know as an investor, let's say you have X number of patents and you have these research trajectories, how successful is that going to be? As an investor, it may be very difficult for me to evaluate that. But I can look at the board of directors, and the quality of the directors that they are able to recruit might actually, you know, give me some level of comfort. And this is kind of how it works, you know, in the financial markets, is that investors do read any signals that they could have access, any visible signals. And this is definitely one of them, because from the board's point of view is also, if you're a very successful director, you're in an important position, you have a belt of you know, accumulation of experience, you're probably not likely to sit on a board of a company that doesn't seem to know what they're doing, or a weak company. So I think that's the reason why it might be read as a signaling mechanism. So, and I think I should also point out that the bios, the biographies of both the CEO and the board directors are provided in the prospectus, and that's the document that they have to provide as they're going public. So, and there's another little piece, you know, a finance component here. So there's also this notion of underpricing. I think, you know, you may have heard about it, but it's what it is the underpricing, and this is going to become our dependent variable, so I really need to explain this. Underpricing is the gap between the offer price, okay, and the first day closing price of the company's stock. Right? So typically, the smaller the gap, the better it is, because that means the offer price closely reflects the value of the stock. If the gap is big, that means the company has generated, created value, but that got appropriated by the investors who bought the stock at the offer price, and then now they can go sell it at the market at a much, much higher. And typically, so this is, actually we refer to this as like, you know, leaving money at the table, you know. So somebody's making a lot of money, but the company is not necessarily the one making a lot of money. And I think the question is also here, so how do you reduce the uncertainty? So the more uncertainty there is about the company, the bigger discount typically is. So how can you minimize the uncertainty and the need for the big discount? So if you're curious about like what is this gap, like how, like it's actually like on average in the US we're talking about 13%. Okay, so between the offer price and the first day closing price, but this 13% can go up to some much higher numbers. Like if I were to give you an example. This is kind of going back a little bit, Globe.com, it's one of the internet stocks, and that's when things got a little bit out of control. Their offer price was 9, and then the first day closing price was 97, so the stock appreciated basically 10 times, almost like 1,000 percentage points. Did they raise money? Yes, they raised $30 million, but they left $300 billion, you know, on the table. So that's just one extreme example. So in this sense, you know, again, what are these potential good signals? We're going to look at key forms of CEO and board human social capital, and the first one that we're going to look at is CEOs and directors' expertise in serving company boards that are on the public domain. So, to what extent does the CEO or the directors have experience on serving not just boards, but boards that are operating on the public domain, which is, it's a huge difference.